While the rest of YouTube has been all about crypto and Tesla, Wall Street and institutional investors think big banks, private equity firms, and hedge funds, these guys were fawning over a third darling, SPACs. Wall Street jumping on the next big trend. So far, so whatever in my mind, right? Happens all the time. Until last week, that is. That's when my 65-plus-year-old father called me and asked, and I quote, "How do I buy the SPAC from this Facebook guy?" This is the same man, and I mean my father, who hasn't even left the house to buy groceries since March 2020. Apparently, SPAC from this Facebook guy is all over Google, in Chinese. Now, you should know, the last call I got from my dad was shortly before the GameStop drama, which this ex-Facebook guy played a hand in as well. So, when my father calls and asks anything like this, I think to myself, oh dear. And that's the PC version of what went through my head, just so that you know. If you're already proficient in SPACs, the ex-Facebook SPAC guy that my father was referring to is, of course, Chamath Palihapitiya, the best thing to happen to Wall Street recently since sliced bread, if you ask some folks. And the SPAC my dad wants me to buy for him? None other than one from Palihapitiya's company, Social Capital. For those of you new to us, welcome to NestEgg, the #1 place to learn about money, investing, and retirement. I'm Jennifer, and I've spent most of my life in finance. Started working at banks like JP Morgan and Goldman Sachs at the age of 17, and graduated top of my class from NYU and Harvard Business School, studying finance and business. And now I work with companies like Bloomberg, WeWork, and Walker Edison, teaching their employees all about financial literacy and wellness. Today, we're talking about all things SPAC. For those of you already familiar with SPACs and who want to dive quickly into the meatier stuff, check out the timestamps in the description below to skip ahead. If you haven't heard of SPACs before, don't worry. This is the SPAC Starter's Guide you've been waiting for. By the end of this video, you'll know what a SPAC is, what the SPAC structure looks like, and how a SPAC works. And you'll be able to explain it to your father and your mother like we just did a few days ago with ours. Before we move along, though, I need to get this out of the way. Please note that NestEgg is a financial literacy, education, and coaching company, and that I'm a licensed insurance broker. We are not a bank, securities broker, legal, tax, or financial advisor, and this video, like all the other stuff on this channel, is for general educational and informational purposes only. All investing involves risk, and past performance is not indicative of future results. As our trademark saying goes, everyone's financial journey is different. We are not fully aware of your individual financial circumstances. To see if we can help you with your specific situation, please email us at jennifer@diamondnestegg.com to schedule a consultation. So, with all those fun disclaimers out of the way, let's jump right in. What's a SPAC? SPAC stands for Special Purpose Acquisition Company. Essentially, it's what bankers call a shell company with absolutely nothing in it except a certain amount of cash. There are no employees, no customers, no products, no sales. Absolutely nothing. Imagine it as a massive piggy bank set up with the sole purpose of raising money through an initial public offering, through an IPO. Raising money from investors that will later be taken out of that piggy bank and used to acquire a private company. Remember that part too, a private company. A SPAC's goal is to buy a private company with the money it gets from investors. Not a public company, but a private company. And when that private company is merged into the SPAC, the private company becomes a public company that's listed on the stock market, just like Apple, Google, or Zoom. This private company is able to do this because the SPAC that's buying it is already listed on the stock market. It's essentially a backdoor IPO for this private company. Why would a private company go public like this by merging with a SPAC via this backdoor IPO instead of a traditional IPO? This is another video topic on its own that we'll cover in our SPAC series over the next few weeks, but very briefly. The reasons for doing it this way versus going public via a traditional IPO is that this backdoor IPO is faster, cheaper, and easier. Think much less poking around by regulators and much fewer questions from regulators, specifically the Securities and Trade Commission, the SEC. From the SPAC and private companies' perspectives, these are all good things. But for the investor, the SEC's sole responsibility is to protect investors and keep the stock market working in a fair and orderly manner while facilitating companies in raising money. So while less regulation sounds like a good thing for the SPAC and the private company that's being bought, it's not necessarily so good for the ordinary investor. Not only that, but when investors first put money into a SPAC, they have absolutely no idea what they're investing in. They have no idea which private company will be bought. In fact, often, no one has an idea. You're probably sitting there wondering, so why should I invest if I have no idea what I'm investing in? I know that's what you're thinking because that's what I and almost everyone else wonders when they first hear about SPACs. Here's why you'd put money in. Because the guy that's asking you for this money, he's well known. He has a good reputation, a great track record. He's already hit that home run. And you hear about his awesomeness in the news all the time. So you're basically betting that this king of awesome will score another home run. Say that Jeff Bezos asked you,
"Hey Jack, hey Jill, do you want to give me some of your money now to put into this Bezos-SPAC? This SPAC's going public on the stock market. This is the SPAC IPO. And with all the cash we raise, I will find a great company to buy in the next 2 years. Not sure which company we're going to buy yet, but trust me, it's going to be Amazon 2.0. And if I don't find anything, y'all get your money back with some interest. How about it, my friend?"
Would you say yes or no? Given that Amazon has about 126 million Prime customers, that's more than a third of the US population as of 2020. I'm super curious to see how many yeses versus nos we'll get. Let us know in the comments below. In this made-up example I just gave you, Jack and Jill are the investors, and Bezos, the one promoting the Bezos-SPAC, is the promoter, also known as the sponsor. I'll be using the terms promoter and sponsor interchangeably in this video. They are one and the same. Let's assume that Jack and Jill and a ton of others say,
"Yes, oh Bezos the Great, we believe in you. You will find us Amazon 2.0 to buy within the next 2 years. Here's our cash."
This is essentially how a SPAC works. It's created or sponsored, promoted by someone well-known or a team of someones that are well-known that have a track record of success in a particular industry, whether that's tech, media, healthcare, or something else altogether. This well-known someone or team of well-known someones, together with Wall Street professionals in banking, private equity, or hedge funds, they then look for even more investors willing to bet on their reputation, track record, and expertise. Because remember, at this point, the SPAC has nothing. No revenues, no products, no customers, no operations, no company. Essentially, the only asset that a SPAC owns is the cash that the sponsors and investors put in, with the goal of eventually finding a private company to buy. Compare that to a regular IPO, where there is a company, there are operations, there are revenues, there's a management team, employees, and so on. The best way to think about a SPAC IPO is this. In the words of Don Butler, managing director at Tom Vets Ventures, an IPO is basically a company looking for money, while a SPAC is money looking for a company. Remember, I said in my disclaimer in the beginning of this video that all investing involves risk and past performance is not indicative of future results? Well, in a SPAC IPO, investors believe the exact opposite, that past performance is indicative of future results. So going back to our example, this money from the made-up Bezos SPAC IPO, it goes into this massive piggy bank that earns a little bit of interest, and within the next 2 years, Bezos, as the sponsor, the promoter, with his great reputation and track record, he has to find the Bezos SPAC investors Amazon 2.0. He basically has a blank check that he can write out to his acquisition target of choice. And that's why SPACs are often referred to as blank check companies. 2 years. 2 years is the time a SPAC has from the point of SPAC IPO to write out that blank check, to find a company to buy and close the deal. Sometimes with a possible short extension if shareholders agree, as was the case with SPAC Form Merger 2 and its acquisition of frozen food company Tattooed Chef. If, in our example, Bezos does not find Amazon 2.0 within the 2 years that he has, he would have to return the money with interest to investors in the SPAC. Sounds good so far, right? You get to invest alongside Bezos, And if you can't find Amazon Part 2, you can still get your money back with interest. Well, watch on, my friend. As I always tell my clients and my family, if it sounds too good to be true, it probably is. There's always a catch, especially when it comes to investing and to potential risks involved. We've already touched upon some briefly, specifically not knowing what this SPAC is actually going to buy when you hand over your money. Next week, we'll do a deep dive into all the risks involved with SPAC investing. And there are quite a few. So if you're interested in learning more about SPACs or all things money related, please give this video a thumbs up and hit that subscribe button. This will help us with the YouTube algorithm and push this video out to others like you who are interested in learning more about the profits and perils of Wall Street's latest SPAC trend. And if you're interested in learning more about investing, be sure to sign up for our investing course waitlist. This Investing 101 course will reopen in a few months' time and will cover investing basics as well as more advanced topics like crypto, SPACs, and so on. I've also included the waitlist sign-up link in the description below this video. Also, as an FYI, Bezos has not announced plans for a SPAC. Bill Gates has though, and so have MLB All-Star Alex Rodriguez and former NFL player Colin Kaepernick. So let's go back to our made-up example of the Bezos-SPAC. When the Bezos-SPAC goes public, Jack, Jill, and all the Bezos believers, they put their money in to buy shares at the IPO price, which is generally $10 a share. This is the investor shares you see here. These investors also get warrants, giving them the right to buy more stock at a fixed price at a later date under certain conditions, such as when the acquisition target is identified or when the deal closes. That fixed price has historically been somewhere between $11.50 and $13. And when I talk about Jack, Jill, and the Bezos believers that buy the SPAC IPO shares, just note that these initial investors are generally also big guns. They're normally big banks, hedge funds, regular retail investors. Think you, me. We can usually only purchase SPAC shares once the SPAC has gone public and is trading on the market, so that you would then buy the SPAC share like you would buy a share of Disney or Microsoft or Amazon. So back to our Bezos SPAC example, in addition to the investor shares that Jack, Jill, and the other folks buy at $10 a share, Bezos also has shares. As the promoter, he will have received founder shares and warrants prior to the SPAC IPO filing, and usually for a very, very nominal investment, say $25,000. These founder shares entitle Bezos to up to 20% of the total stock shares outstanding after the IPO, which translates into a pretty big chunk of the private company that the SPAC will eventually buy. In addition, Bezos can supplement his founder shares by buying more shares at the SPAC IPO if he wants, at $10 a share, like Jack and Jill and all the other investors. It's a good way for him to put his money where his mouth is and boost investor confidence in the SPAC. Let's continue on with how things work after the cash has been raised via the SPAC IPO. At least 85%, although some sources say this number is often as high as 97%, so somewhere between 85% and 97% of the SPAC IPO proceeds are placed in an interest-bearing account for the future acquisition, with the remaining funds going into an expense account reserved to cover IPO underwriting fees, SPAC operating expenses. This includes due diligence, legal, and accounting fees. If, or more often when, the SPAC promoters, in this case Bezos and his team, when they find an acquisition target, they make a formal public announcement and move on to due diligence, meaning they go through all the paperwork, research, and motions to confirm that the acquisition target, its operations, and management are legit and not a fraud. The SPAC promoters also negotiate with the acquisition target the purchase price and other pricing details. And the SEC, they also review the acquisition terms. Thank goodness for at least this level of regulatory oversight from the Securities and Exchange Commission. The next step is for the SPAC investors to vote on whether they approve or disapprove of the acquisition, and also to decide if they want to redeem their shares in the SPAC. meaning they want to pull out of the SPAC. For example, if they think the acquisition target sucks. And when they redeem, they get back their share of money from the interest-bearing account, from that piggy bank. If a majority of investors give the go-ahead, then the acquisition goes through so long as the number of shareholders who want to redeem is below a specific percentage, usually somewhere between 20% and 30%. If more than 50% of investors disapprove of the acquisition, then the interest-bearing account is closed and all the funds are returned to investors. The acquisition target usually costs the SPAC about 2 to 4 times the amount that was initially raised in the SPAC IPO. So to close the entire deal, as well as give cash back to the investors that want to redeem because they think the acquisition is not such a great idea, more debt and or equity needs to be raised from additional investors. The equity portion is known as a PIPE, an abbreviation for private investment in public equity. Finally, once the acquisition is approved and the debt and or equity is raised, the transaction is considered closed and the acquisition target is formally merged into the SPAC and listed on the public stock market. Now that you fully understand in detail what a SPAC is, what the SPAC structure looks like, and how it works, what do you think? Would you invest? Drop us a comment below and let us know. And if you said yes, you would invest, please wait until at least next week before you dive in head first with your investment. That's when we'll be talking about the risks around SPAC investing. So be sure to hit that subscribe button if you're considering plunging into SPACs. You'll be the first to know when our latest SPAC video comes out next week. You should also know that for the time being, my father is SPACless. Thanks for watching. If you enjoyed this video, be sure to smash that little thumbs up. It tells us that we are doing something right here. It also sends positive messages to YouTube. As always, if you have any questions or want to see if we can help you figure out your financial situation, shoot us an email at jennifer@diamondnestegg.com.